Hello, everyone. Thank you for joining us for our session, The Gender Gap in Housing Returns, with our special guest, Kelly Shue, Professor of Finance at the Yale School of Management. My name is Sanya. I'm a part of the higher education team here at Ivy Exec, and I will be helping to moderate today's session, along with Wendy Tsang, Assistant Dean of the Executive MBA program at Yale School of Management. Before we begin, I have a few brief housekeeping items for our audience. First, all attendees are in listen-only mode. However, we encourage you to engage in the session by asking questions, which you can do using the Q&A feature you can find in your controls at the bottom window. Please make sure to use this feature for all the questions you may have for the presenter, while we invite you to use the in-chat feature for sharing any thoughts you may have with the rest of the audience. We will also be having a formal Q&A session during the last 15 minutes, but feel free to send in your questions throughout the session. Additionally, we are recording today's session, so you can look forward to receiving a copy of the webinar via email in the coming days. And now it is my pleasure to pass the floor to Wendy, who will introduce you to our presenter today.
Thank you so much, Sonia, and thank you to those who are joining us today. My name is Wendy Tsang, and I serve as the Assistant Dean of the MBA for Executives program. The MBA for Executives at the Yale School of Management is a program designed for mid-career working professionals in a variety of industries and functional areas. Along with a year of coursework in our integrated core curriculum, students have the opportunity to deep dive into one of three areas of focus at the nexus of business and society, and those are asset management, healthcare, and sustainability. Our students complete the program over a 22-month period during which they attend class in person at Evans Hall on the Yale University campus in New Haven, Connecticut, every other weekend on Friday and Saturday. They also have the option to attend remotely through our extended classroom technology, which had allowed us to transition seamlessly to a hybrid model during the pandemic. Class weekends include optional social activities to get to know the university and Saturday workshops to enhance their professional development, delivered by top members across the Yale faculty. The program begins with a 2-week residency period in July. Students study and travel internationally through a required Global Network Week. They start their second year with an additional week of residency. Throughout their 2 years, students participate in colloquia, where leaders in business and academia share their experience, expertise, and insights. Today, it is my pleasure to introduce such a leader, Professor Kelly Shue. Professor Shue is a professor of finance at the Yale School of Management. She received her undergraduate degree, master's, and PhD from Harvard University. Professor Shue's academic interests lie at the intersection of behavioral economics and empirical corporate finance. Her research has explored executive social networks, compensation and promotions, sequential decision errors, M&A, corporate social responsibility, persuasion and corporate financial reporting, and errors in voting. Her work is very relevant and accessible and has been featured in numerous news outlets, including CNN, NPR, and the Wall Street Journal. She has won several awards for her research and serves as an editor at the Review of Finance and associate editor at the Journal of Finance. Before joining Yale, Professor Shue taught at the University of Chicago's Booth School of Business. We hope this opportunity to hear from Professor Shue will offer insight not only into her unique work, but also into how our faculty at Yale SOM regularly brings their research into the classroom. Professor Shue, thank you so much for joining us today. I'm going to pass the floor on to you.
All right, thank you very much, Wendy, for that kind introduction. I'm excited today to share some new research with you. This is joint work with my co-author, Paul Goldsmith-Pinkham, who is another professor at Yale SOM. And I'm going to share with you some of our findings relating to the gender gap in housing returns. I'm hoping to stimulate a lively discussion. I'm interested in all your views regarding this topic. So I'm planning to share the results with you for the first 40 or so minutes, and I want to leave plenty of time at the end for questions and discussion. Okay. All right, so we're motivated in our research by this idea that housing wealth is really important. It's the dominant form of savings for US households. Housing also differs from other common forms of financial investments and savings, such as bank deposits, bonds, and stocks, because housing is highly illiquid. It's also a heterogeneous asset that delivers consumption flows. So some people just might enjoy housing more than others. And further, we're not really price takers in the housing market like we are in the stock market. Instead, prices for housing are commonly determined through bilateral negotiation. We're also very motivated by research showing significant gender differences in financial investment strategies, as well as preferences for risk and competition, and finally, gender differences in negotiation strategies and negotiation outcomes. So with this backdrop, we want to investigate how men and women differ in their financial returns on housing investment. And this is a quick preview of what we find. We're using a new data set that Yale SOM recently acquired, which has 53 million US housing transactions from 1990 to the present, covering most US states. And what we uncover is just a very large gap in the returns that single women are earning in the housing market relative to single men. So we find that single women on average earn 1.5 percentage points lower annualized unlevered returns per year relative to single men. If we account for leverage, so if we adjust for the fact that most people buy housing with a 20% down payment and they borrow the remaining 80%, that gender gap in annual returns actually jumps to an enormous 7.9 percentage points per year. We find about 45% of this gap is explained by gender differences in market timing. So single women are just more likely to buy in places and time periods when prices are high, and they're more likely to sell in time periods when prices are low. We also uncover some interesting things going on with couples. So couples actually earn lower raw returns on average, even relative to single women. But a lot of the poor performance of couples has to do with their poor market timing. Okay? If we compare all these groups, but condition on they buy and sell at the same point in time, the ranking goes single men perform the best, then couples, then single women. And further, couples, I don't want you to just think of as in between single men and single women. They seem to have interesting dynamics. So I'm going to show you that couples actually do quite poorly when they buy, possibly because they're constrained, they've got children they need to buy right now. And actually couples do quite well when they sell, possibly because they're not as constrained at the point of sale. Okay, so in addition to these differences in market timing, we show that the remaining gender gap, so the remaining 55%, arises primarily from differences in execution prices. So we're going to account for the fact that men and women like different types of housing. Okay? But if we hold the house fixed and just look at it at repeat sales, so transactions on the same house over time by men and women, we find, and adjust for house appreciation and time trends, what we find is that women will buy the same house for about 2% more and sell for about 2% less. Okay. And further, women don't just buy for more. They'll actually, even though they bought for more, they on average list the house for less and still get worse negotiated discounts off of that list price. And finally, the prices and discounts off of that list price vary with the gender match between the buyer and the seller. So the highest abnormal prices occur when it's a male seller matched with a female buyer. And the lowest abnormal prices occur when it's a female seller matched with a male buyer. Okay. We did consider lots of other channels that could affect this gender gap in housing returns, and it's not our goal to rule them out entirely. We do believe that they're less important. So it could be, for example, that men earn higher returns on housing because they buy riskier properties. So their higher return is just to compensate them for the greater risk that they're bearing. Or it could be that men are more likely to buy fixer-uppers and they invest more in ongoing maintenance. And that's again why men earn higher returns. Okay. So to repeat, it's not our goal to rule out these explanations, but we are going to introduce a variety of evidence to show that these do not appear to be the dominant channels. So in particular, what we show is that in very tight markets, so in markets in which there's not much room for negotiation, right? So it's a very hot housing market. We've got lots of people bidding on the same property, and the house is typically going to go to the highest bidder. In those markets, the gender gap approaches zero, controlling for the time period. Okay, so that suggests that a lot of this gender gap has to do with something that happens during the search for the housing and negotiation. If we remove that negotiation aspect, it's not true that women bid more and for houses, pay more, and then earn lower returns. Okay, so I'm going to show you the evidence in a minute, but for now, I'm actually curious about the experiences of the particular group now at Ivy Exec. So I'd like to launch a poll, and I'll launch that right now. So you should be able to see within your Zoom window a poll, and I'll just walk you through this poll with you. Okay. So the first question asks, when you bought or sold a house in the past, how did you think about market timing? Market timing, I mean buying when prices are low or trying to sell when prices are high. Okay, so the questions are always divided as first, do you identify as female or male? And then did you try to time the market? Or maybe you considered market timing, but then you ultimately decided you had to buy or sell at a particular time for other reasons. And the final choice is you did not consider market timing. Okay, and by the way, for these questions, if you didn't ever buy or sell a house in the past, you can either skip these questions or think about some other large purchase that you made, such as buying or selling a car. Okay. All right. Next question asks, when you bought or sold a house in the past, how did you negotiate? Again, it's divided by first whether you identify it as male or female, and then the responses are you didn't try to negotiate, or you did try to negotiate, and you had what, in your opinion, was a favorable outcome. Or the last option is you tried to negotiate, but in your opinion, you had an unfavorable outcome to the negotiation. Okay. Moving on to question 3. This question is about how you interacted with your real estate agent if you had one. Okay, again, do you identify as male or female? And the options are, first one, you followed the advice of your agent, or 2, you pushed back against the advice of your agent. So this would be, for example, your agent told you to list or put an offer at a particular price and you decided to do something different or question that person's advice. Okay. Moving on to the last question. Suppose you sold a house in the past. How did you choose your initial list price when you put that property up for sale? Okay. Again, do you identify as male or female? And then in your opinion, did you choose a fairly aggressive price? So that would be high relative to maybe the market or what other people recommended. Or did you choose an attractive price? So that would be a price that's appropriate or low relative to what you think was happening in the market or what your agent advised. Okay. All right, so I will leave this poll open. You're free to work on it as I progress, but I'm going to move back to the slides. Okay. All right, so I'd like to then put the magnitudes for this phenomenon into perspective. So what we're discussing here is a quite large gender gap in both return and dollar units. So in returns, for the typical levered homeowner, we had said that single men are earning almost 8 percentage points per year higher than single women on housing. So that gender gap itself is larger than the equity premiums, the extent to which stocks out-earn bonds on average. It's also quite a large gender gap in dollars. So let's consider the median house, which has a price of about $200,000, and the median holding period about 5 years. Since women are losing about 2% at purchase and sale, that says that women are losing about $1,600 per year during the 5-year holding period relative to single men. We're probably used to thinking about a gender wage gap. The gender wage gap, after conditioning on education and industry, is about $2,800 per year. So the gender gap in housing markets that we're talking about today is approximately half the size of the gender wage gap, so quite substantial. And finally, the gender gap in housing is going to matter for differences in wealth accumulation. So women with the median level of wealth have about 70% of their net worth invested in housing. So you may have heard that the US overall has pretty low savings rates, okay, compared to other countries. That is true, but to the extent that Americans do save, most of their savings is wrapped up in housing. So if one group is out earning another significantly in housing, that's going to affect the wealth accumulation differences across these groups. So we find that the gender gap in housing can explain approximately 30% of the gender gap in wealth accumulation at retirement for single men relative to single women. All right, okay. These are the differences in wealth accumulation at retirement. This is differences in the mean and the median. So of course, medians are less than the mean because we have a right tail of very rich households in the US. What we see here for the median is just couples, as you'd expect because there's two people saving, have higher wealth at retirement, which we define as age 65 and older, relative to single men and single women. However, over here, this empty spot right here, that's the gender gap in wealth accumulation, for which we think housing is a significant contributor. Okay. All right, let me now talk to you briefly about the measurement and data before I get to the results. As I mentioned before, we're using new data acquired by Yale, which has county deed records and for over 53 million observations. We're going to restrict to arm's length transactions. So we want to exclude transactions in which it's a family member giving the property or transferring to another family member, and we exclude refinancings. This covers most US states from 1991 to 2017. We're going to link that to MLS property listings, for which we have about 20 million observations. What's nice about the property listings is we get to see the initial listing price, and we also get to see the price that the property transacted at. So we get to observe the negotiated discount. I think another compelling channel that we explore is maybe one group of people is more likely to maintain or upgrade a home than another. Well, that would explain why that group earns higher returns. So using the listings data, we can search that text for mentions of maintenance, upgrades, and other property features. And we're going to supplement that with data on demographics from the census and the American Housing Survey. Okay. Because the deed records contain the names of buyers and sellers on each side of the transaction, we're basically going to use the names to identify whether each party is likely to be male or female. We can't do this perfectly, but we're only going to use cases in which we're more than 95% confident that this name represents a female or a male name. And we're going to use Facebook data to validate this. So the categorization is as follows. Single person means there's one person on the transaction identified as female. Single male is one person identified as male. A couple is two people with identified gender, and we include same-sex couples here. And other is everybody else, including institutions and those with unidentified gender. Okay. So unfortunately, this means that for some people, we are going to identify their gender incorrectly. Okay. To get around this problem, what we're going to do is we supplement with a different data source, which is the American Housing Survey. This survey just asks people, how do you identify, male or female? And we find a similar gender gap using this alternative data set. Okay. Then in terms of how we measure housing returns, let's just think about a property. So it's like a house I that was bought, oops. Let me get back to that slide. We think about a property I that was bought in year B for price PIB and sold in year S for price PIS, okay? And then we're going to restrict the sample to identified female, male, and couples. And in particular, we want the family structure to be the same at purchase and sale. Okay, so we require to calculate a female return that someone be single female at purchase and sale, or for computing a couple return that the buyer and seller remain a couple at purchase and sale. This is really important because there's a whole separate interesting question of what happens in the case of a divorce or a death. Okay. So you can imagine that a couple that then becomes divorced may sell in a different fashion, earn lower returns, perhaps because they need to liquidate their assets quickly. I think we will look at that in the future, but for now we've excluded those situations from our sample. So based upon that, we can calculate the realized annualized unlevered return. It's basically just the ratio of the sale price to the purchase price, but essentially divided by the number of holding years. Okay. All right. So here are our baseline results. Okay. So there's a lot going on in this figure, and I'm going to walk through it slowly. First, let's just consider the orange bars, and we'll look at the top orange bar here. This shows you in our raw data across all of our observations, on average, single women earn about 1.5 percentage points lower returns on housing relative to single men. So it's always relative to single men. Okay. As we look at the orange bars and we move down, this is comparing how single women compare to single men, but among those that sold their property in the same zip code and year month. Or as we move further down, we're going to compare those that bought and sold their properties in the same zip code and year month. Okay, so this is controlling for timing differences. What we see is as we move down, the length of these orange bars contract. And what that tells you is a big portion of this initial gender gap is just due to differences in market timing. On average, in the past, single women were more likely to buy in time periods when aggregate prices were high and sell when aggregate prices were low. So that market timing already explains a big portion of the gender gap, but it doesn't explain all of it. Okay, so if we condition for market timing and we're only comparing those that bought and sold in the same locations and months, there still is a very large gender gap of about 0.8 percentage points per year. Okay. The blue bars tells you how well couples are doing relative to single men. Okay. So on a raw unadjusted basis, couples are actually doing terribly. Okay. So couples actually underperform even single women. However, what I think is really interesting is notice that as we adjust for market timing, the length of these blue bars, they change a whole lot. Okay, so that's telling you the main reason why couples underperform other groups is couples are bad at market timing. And when I say bad, I don't necessarily mean that they don't understand market timing or they don't try to market time. They could be prevented from transacting at advantageous times for other reasons, such as they need to buy when school starts, they need a certain school district, they need to buy a house and move out of an apartment because they have a new baby. Notice that in the very bottom, so we're comparing groups that transact in the same period for both purchase and sale, couples actually outperform single women, but they underperform single men. Okay. So that was what happens if we look at just returns, assuming that these were all cash purchases. But of course, most Americans don't buy homes with all cash. The majority of US homeowners, we buy our homes using debt with loan to value, so that's LTV, of greater than 80%. So in this example, suppose you buy a house at $100,000 and you sell at $105,000. Let's keep things simple. You do this all in 1 year, okay? If you bought that house all cash, you would earn a 5% return. However, let's suppose you took a standard 20% down mortgage. So if you made a $20,000 down payment and borrowed the remainder, you actually earned a 25% return, right? Because you earned $5,000 on a $20,000 investment. Okay, so in general, leverage is going to amplify the returns that we earn on housing by up to 5-fold. And therefore, it's going to amplify any differences in returns across men and women. As an aside, I think leverage is why many people view housing as such an attractive investment. So you may have heard people comparing housing investment versus investments in the stock market and how one is better than the other. On a risk-adjusted basis, if we don't account for leverage, it's not clear that housing outperforms the stock market. However, it's really easy to take a levered bet on housing. It's easy to get a mortgage in the housing market and borrow the remaining 80%. It is much more expensive because you don't have physical collateral to borrow as much and take such a strongly levered bet in the stock market. Okay. All right, so let's suppose that each of these groups were 80% levered. So they put 20% down and they borrowed the remaining 80%. What would the gender gap in housing returns be? Okay, so this is again, single women and couples relative to the reference category, which I'm always going to use as single men. Okay, so if we don't condition on buying and selling in the same time periods and locations, women are earn about 8 percentage points lower returns relative to single men. That's this 0.079 number here. If we account for in column 5, we're controlling for zip sale and zip buy year month. So we're comparing groups that bought in the same zip code and year month. Women are still underperforming single men by 3.7 percentage points each year. And then couples are underperforming by 1.5 percentage points each year. Okay. All right, this is the difference in groups returns over time. So housing returns depend strongly on when you buy or sell. Okay, they vary a lot with the business cycle. What I want you to take away from this figure, if you look at the far right, is the gender gap. So that's the gap between the green line and the orange line. That has not shrunk to 0 in recent decades. If anything, the gender gap seems to get larger in years when everybody's return is higher, and it shrinks when everybody is doing poorly, but otherwise has not shown a secular decline towards 0 over time. Okay. All right, so that had a lot to do with market timing. Now I'm going to show you evidence having to do with a gender gap in execution prices, but we're going to take out the market timing component, okay? So what I'm about to show you next is always comparing single men, single women, and couples who transacted in the same zip code and year month. Okay, so this is removing that market timing component. And we're going to see that there's still a pretty large remaining gender gap in these execution prices. Okay, so first we can look at the transaction price. All of this analysis comes from, we're going to look at holding the property fixed and comparing men and women who sold the same property, okay? It's important to do this because, of course, men and women may just prefer different types of property, and that's going to affect their returns. We don't want to use that component, okay? So looking at the same property, on average, single women, these are the orange bars, buy for almost 2% more. And then even though they bought for more, so you might think maybe they paid more for the house because they just love this house more, okay? And we're not saying that's not the case, okay? But it's still surprising then that they bought this property for more, but then they sell the same property for about 2.5 percentage points less, okay? I promised you earlier that couples display interesting dynamics. So couples, do not think of it just in between men and women. Couples have their own interesting dynamics. So what we see is when couples buy, they do really poorly. They buy for almost 3 percentage points more than single men. That's this blue bar here, okay? However, when couples sell, they actually do really well. They outperform single men by about 1.5 percentage points. So couples do very poorly when they buy, and they do quite well when they sell. Okay. The transaction price is also going to vary by the buyer-seller gender pairing, okay? So here, the reference group, which I've omitted, so that's a male seller that matched with a male buyer, okay? In comparison to this reference group, which I've normalized to 0, the lowest abnormal prices occur when it's a female seller that has matched with a male buyer. And the highest abnormal sale prices occur in this third bar here, when it's a male seller that has matched with a female buyer. Okay, and again, all of this is holding the house fixed, looking at different buyer-seller gender pairings. Okay. We can also think about list prices. So list prices are, if you make an MLS listing, what's the initial price that you quote? Okay, what we find is that when single women purchase homes, they tend to go for homes that are listed abnormally high, about 3% higher than the set of homes that are chosen by male buyers. Okay, couples go after homes that are listed a little bit abnormally high. However, when women go to list their homes, so they're about to sell their homes, they actually list for almost 2% lower. Okay. All right, that was list price. Next, we can look at the discount relative to the list price. So we're measuring the discount as list price minus the final transaction price scaled by the list price. So a bigger discount defined in this way is going to benefit the buyer and it hurts the seller. So if you're a buyer, you want a big discount. And if you're a seller, you don't want to give a big discount, okay? So what we find is that even though women, when they buy, they go for homes that are listed high, so you'd think they might be able to get a big discount off of that high list price, they actually have far lower discounts relative to what single men get, okay? And then we can look at the sale discount. Recall I had just said that women, when they sell, they tend to already list at a very attractive price, okay? What we see here is even though these women sellers, they chose an attractive list price, they still end up agreeing to bigger discounts off of that lower list price than single men, okay? Couples, again, have their own dynamics, which is when they buy, they negotiate worse discounts relative to single men. However, when couples sell, couples actually choose to list for very high and they don't agree to big discounts, okay? So they agree to smaller discounts relative to single men. So couple sellers really don't like to budge very far down relative to their high list price. The discounts, again, vary by the buyer and seller gender pairing, okay? So again, I'm going to set the base group, the reference group, as male sellers that have matched with male buyers, okay? Relative to this reference group, notice that the largest discounts off of list price occur when a female seller has matched with a male buyer. And the smallest discounts off the list price occur when it's a male seller that has matched with a female buyer. Okay. Given all of this data, it would seem like if you just wanted the best possible price in housing transactions and you had a bunch of homes you were indifferent with, it is most advantageous just from a pure price perspective to match with the female counterparty, because that corresponds to the best price for the other side, okay? However, we've also examined evidence of strategic matching, and we actually don't find much of that going on so far in the data, okay? So I had mentioned so far that on average, female sellers, they choose to list for lower, and they also end up agreeing to larger discounts off of their already lower list price. We can then examine, are they rewarded for this behavior in terms of faster transaction times, right? Because one reason why you might want to list at an attractive price and agree to a big discount is you just want to get this house off the market. Okay. Here's what we find in terms of the distribution of sale days on market, which is that female sellers do sell approximately 3% faster. But this translates to only 1 or 2 days less on market. Okay, so I think for the typical home seller, this is not a good trade-off to lose 2% on the full value of a house in exchange for 1 or 2 day faster transaction time. We are also looking into whether single men, perhaps because they list aggressively, do they have a lot of failed listings? Okay, and so far our suggestive evidence seems not to be the case. Okay, so if anything, this analysis has told me to be very cautious about interpreting this advice that sometimes, oh, we should list very low because that means we might end up transacting a lot faster, or we might actually end up at a higher transaction price because we priced so attractively in the beginning. That type of advice does not seem to be borne out as correct in the data. Okay. We also considered other potential channels, and it's important. I call these other potential channels rather than alternative explanations because we're not pushing any particular explanation, right? It's just the data shows this gender gap and we're interested in occurring for any possible reason. So these are some reasons that we considered. So one could be that men buy riskier homes or with characteristics associated with higher returns. So for example, let's suppose that buying oceanfront property is a very risky investment. If it's a very risky investment, then we expect people with oceanfront property to earn higher returns on average to compensate them for that risk, okay? However, we find a pretty similar gender gap after carefully controlling for and comparing properties with the same set of descriptive characteristics that we observe on the MLS property listings data. Okay. The next type of alternative explanation could be that men might invest more in upgrades or home maintenance. Okay, so maybe men buy fixer-uppers, so they buy at a low price. They invest a lot of their own time and money into the house, and then they sell for more. Maybe that's why men earn higher returns on average. However, what we can show is that there's a similar gender gap for homes that do not mention any upgrades or maintenance on their property listings. We can also look at data from the American Housing Survey, which just asks homeowners, how much did you invest in house maintenance, okay? And in that survey, what we find is actually just couples invest more than single men and single women, but single men and women invest approximately the same dollar amount. This isn't perfect because it could be possible that single men invest more of their own time and effort, just not more dollar amounts into their homes. I'll talk more about that explanation later. Okay. Why do women earn lower returns in the housing market? It could be women are on average older, partly because they live longer. They may have more children, which constrains the way that they engage in housing transactions. They may be less educated on average, et cetera. What we find using data from the American Housing Survey is, first of all, these demographics do matter. So more educated people, they earn higher returns on housing on average, okay? Having children strongly predicts lower returns, okay? For all groups, single men, couples, single women, okay? But even when we compare men and women with similar demographics, so similar incomes, similar education, similar number of children, there is still a pretty large gender gap in unlevered returns, about 1 percentage point per year. And further, the negative effect of being female is equivalent to having 3 additional extra children in the data on average. The fourth explanation that we considered, and I think this is worthy of further consideration, is what if women employ worse real estate agents? So housing transactions are heavily mediated and advised by real estate agents, okay? What we show is that this gender gap is unlikely to occur by women matching with systematically worse listing agents. Because for each agent, we observe their code and we can control for their average impact. And what we find is that women on average do not employ worse real estate agents, okay? However, there's another effect that could be going on, which we would not be able to pick up with our data, okay? And it could be the same agent may interact differently with male or female clients, okay? So if you have a cynical view of real estate agents, you might think on average they give bad advice. Well, perhaps their female clients are more likely to listen to that bad advice. Meanwhile, their male clients just reject the advice and do their own thing. Alternatively, it could be the agent gives on average good advice, but the agent gives that better advice differently to men than to their female clients. Okay. Last thing I want to cover before I open up for discussion and questions, and again, questions are encouraged. You can put them into the Q&A feature. Is let's consider men buying riskier homes or men investing more in upgrades or maintenance. We believe those two channels are inconsistent with the next two pieces of evidence, which have to do with holding length and market tightness. So let me move toward the holding length evidence now. So far, we've shown that women buy the same property for about 2% more and sell for about 2% less relative to single men. Okay? If we think in finance terms, this is equivalent to women getting worse execution prices on their real estate investment. Okay, so if you were investing in any financial asset and you know that you're getting really bad execution prices, or basically your broker is taking a big chunk of money away from you each time you trade, then the solution is to become a long-term buy and hold investor. Why? It's because the loss that you take at purchase and sale is going to be divided over a greater number of years if you were a long-term investor. So therefore, your disadvantage in terms of your annualized return is going to shrink to zero if you buy and hold for a long period of time. Okay? All right. So under the execution prices story, we predict that the gender gap in annualized returns, that's going to converge towards zero as holding length increases. Okay? Basically, women would get hit by 2% at purchase and sale, but because they earn the same rate of return as single men in between for the number of years that they hold, their average return divided by the number of years is going to be about the same as men, okay? On the other hand, suppose that you are thinking about a risk and maintenance story, which is that single men just buy riskier properties, or they invest more of their own time and effort every single year in improving these homes. That means that every single year, men are going to earn higher returns on their property, and that gender gap in annualized returns is not going to converge towards zero if we compare groups of people that hold for a long period in time. Okay? So this is what we actually find. This is the gender gap in annualized unlevered returns by holding length. So holding length is how many years between purchase and sale, and this is the gender gap per year, okay? And notice that this converges towards zero, okay? So this goes against a risk or maintenance story, okay? Also, I wanna make clear, the gender gap in execution prices does not disappear if we hold for 8 years, okay? This is the gender gap in purchase prices among those that hold for 1, 2, 3, 4, up to 8, 9, 10 years, okay? So it's still true among those that hold for 8 or more years, single women are buying for about 1.5 percentage points more than single men. This is the gender gap in sale prices by holding length, okay? So it's still true among those that hold for 8, 9, or 10 years, single women are selling their properties for about 1.5 percentage points less than single men. So single women are still getting hit at execution prices if they hold for a long period in time, but because they earn the same rate of return as single men in between, the impact of losing at execution, if you're a long-term investor, that starts converging towards zero, okay? So, we don't have, unfortunately, a lot of advice from this paper about how to get rid of this gender gap, but one thing that single women could do, if they're aware of their disadvantage in the market, is try to become buy and hold investors instead of transacting often. Last piece of evidence has to do with variation by market tightness. So most of what I've shown you today, that has to do with the typical home transaction in the US, which is the market is not very hot. There's not a lot of buyers showing up at the same time, so there's lots of room for negotiation, okay? We're going to measure market tightness as a fraction of listings sold within each county month. Now, in very tight markets, multiple buyers are trying to get the property at the same point in time. So it's less about bilateral negotiation, and instead the seller holds something like an auction, right? The buyers submit bids, and the seller can just choose the highest bid, plus some other considerations, okay? So as the market tightens, what we find is that the gender gap in returns, prices, and discounts, they all shrink towards zero. Okay, so imagine Manhattan, certain places in Silicon Valley, San Francisco, et cetera, back before the pandemic, okay? Imagine those markets where there's not much room for negotiation. In those markets, we actually find zero gender gap in prices or returns or discounts, okay? So this is inconsistent with this idea that men in general like to buy riskier properties or invest more in maintenance or upgrades, because you would think risk and property characteristics would be even more efficiently priced in these very liquid markets. This evidence is also inconsistent with a simple explanation, which is women get bad returns from housing because they also get so much extra happiness or utility from housing, okay? We think, that could be true, but it's unlikely to be the only explanation, because if women just love a particular house and they were more willing to pay for it, they would also presumably bid higher in these tight housing markets, and they would win the property, but because they bid such a high price, they would have a lower return in these hot markets. And we don't observe them getting a lower return in these hot markets, okay? All right, so let me conclude, and then I'll go over some survey responses and then start taking questions. What we have here is a pretty descriptive finding. We just find a very large gender gap in housing returns. About half arises due to differences in market timing. And then even holding market timing fixed, women appear to get worse execution prices. And that seems to have to do with search and negotiation, right? So women, even though they buy for more, they list for lower and end up agreeing to worse discounts from their perspective. So the implications are there is a gender gap in housing returns that we should care about because it's going to matter a lot for wealth accumulation by each group. I wish I could say more about what women could do to do better in the housing market. Some strategies are they could hold for longer, or they could sort toward tighter markets in which negotiation is going to matter for less. And then finally, I want to leave you with this idea that I don't think we should conclude from this evidence that women are doing something wrong in the housing market. I think it's too easy to say this is because women don't ask or they don't push aggressively. Okay, so that could be true, but there's some interesting evidence about how women, even when they do try to negotiate, the other side, male or female, seems to be more averse to any aggressive negotiation if that negotiation is made by women. Okay, so it could be that women don't ask, or it could be that women do attempt to negotiate, they just don't get the outcomes that they desire. All right, so before I take questions, I want to end polling and I want to show you the results. Okay, so I'll leave the results here for you to consider in your own time. But one thing the reason I wanted to make this poll is one time I gave this presentation in the past toward an industry audience, and I had a question raised that distressed me a lot. So the question was, should we conclude from your research that we should avoid female fund managers, especially if they invest in illiquid assets like bond funds and other funds, where the price has to be negotiated? And I was like, oh my God. We really do not want you to reach that conclusion, okay? So what we've shown here is that women do perform worse on average in housing markets, but if you're going to look at other settings, we often have a very selected sample, right? So if we're looking at the sample of fund managers, maybe we've already selected a group of men and women who just excel at managing funds and negotiations. Similarly, for an Ivy exec audience, so many of you have a lot of financial experience, a lot of business experience. So it's not obvious that a gender gap that we observe in the general population overall would occur within this audience, okay? All right, so let me end with that, and then I'll start taking questions.
Wonderful. Thank you so much, Professor Xu. Let's see. Sharon has a question here that asks, does race impact the price when a family, when a female is Black or another minority?
Oh, sorry, could you repeat that?
Does race impact the price when a female is Black or another minority?
It's a very good question. So we were not able to study that with our data because in exchange for high sample coverage, so over 53 million observations, we only had people's names, and it's more difficult to infer race from names than gender, although you can attempt to do both with error. I will refer you to some other interesting studies. There was one study that looked at 4 large metropolitan areas. And there, they didn't study financial returns, but they looked at just buyers. And it seemed like African-American buyers were buying the same property. Again, they did their same strategy, hold the house fixed, look at multiple transactions over time. And it seemed like Black buyers were buying for about 2 to 3% more relative to white buyers. One thing that we did look at in our data is we have the second smaller sample where we know people's gender and race, okay? So we found large racial gaps in that secondary sample as well. However, those racial gaps got much smaller, so they shrank towards 0 once we conditioned on income and education. So it seems like we should care about a racial gap, but it seems to be due to differences in education income across groups. What was interesting about gender is the gender gap doesn't shrink much when we condition on income and education. And this, by the way, is something that I think people who teach negotiations in business schools struggle with a lot, which is it's hard to make that gender gap in negotiation disappear. We can teach our students identical strategies. We give them identical scripts. So they're not doing anything differently. But they still get different outcomes.
Kevin asks, are there differences between whether a single woman versus a single male would use a buyer side broker agent to complete a purchase? Is one favored versus another?
I think it's a good question. I unfortunately don't know. I have asked, and anecdotally, it seems like most people use an agent. And it's really kind of the more highly educated or professional property investors that avoid using an agent. So the majority of Americans do use an agent. That said, for my sample, I don't know.
And a follow-on to that, is there a way to identify the sex of the agent in the transaction? And does that have any bearing on whether or not men uses more male agents, female uses more female agents, and the outcomes related to that?
So we unfortunately don't see the agent's name, which we see their code. Okay. So for each agent code, and unfortunately we can't figure out the gender from the code, we can measure the average kind of value added of the agent. Okay, because we see that agent appearing across multiple transactions. So the most I can say is female sellers don't employ, on average, agents with lower value added. Okay, so they might be matching on gender, we don't know. So what I think is going on is if we can hold the same agent fixed, they could still be interacting differently with male and female clients.
Thank you. There are a lot of interest related to agents in the questions. You also mentioned that women go for homes that are listed higher. Did you dig into why that was? Is there research or psychology behind that, or how to overcome that?
So part of the reason why I don't make strong welfare claims is I'm showing that women earn lower financial returns in housing, and we should care about their financial returns. But that doesn't necessarily mean that women are worse off, right? Because we also consume housing. We get a direct benefit from housing, and it could be that women and also couples, they get their perfect house. okay? So I don't want to offer advice about housing search strategies, because it could be that couples and women, when they go after homes with high list prices, it's because they want to get the particular house that they want and that they enjoy. At the same time, I don't think this is a complete explanation, because usually you would think if you love your particular house, you wouldn't then go and sell it for 2% less. So if anything, I think we should concentrate on the sell side of these transactions. You know, when you buy, I get it. You should, it's not just about the price. You should get the house that you want. But when you sell, then it seems like, I mean, we don't usually care that much who we sell to. And maybe we should try to sell at the best price possible.
Yeah, you have to love that house if you're going to be in there and hold it for any extended period of time, right? Erica asks that you mentioned in business negotiation class, when students use the same techniques, they get different outcomes because of gender. Can you expand on that a little bit more?
Sure. So I think the clearest evidence of this comes from an ultimatum game. Okay, so in an ultimatum game, two people are just randomly matched with each other. And let's say I'm player 1 and Wendy is a player 2. Okay, so in an ultimatum game, I'm given $10 and I decide how to split that $10 between myself and Wendy. So I might choose to keep $7 for myself and give $3 to Wendy. Okay, and Wendy gets to accept or reject. Okay, if she accepts, I get 7, she gets 3. Okay, if she rejects, we both get 0. Okay, so rejection in an ultimatum game just means you're kind of offended by my offer and you'd rather we walk away and don't transact, even though we're technically both better off by transacting. Okay, and what the evidence on ultimatum games has shown is, let's suppose we randomly match people up in ultimatum games and we only tell the players the other player's gender. Okay, what we found is for the same offered split on average, which is $7 for me, $3 for Wendy, Wendy, or basically player 2, is more likely to be offended by this type of aggressive split if she knows that I'm female than if she knows that I'm male. Okay, so, and it's regardless of whether Wendy is male or female. It's just anytime that there's an aggressive offer or an aggressive way of choosing to split a surplus, if it's known that the person proposing that split is female, it's kind of viewed as more offensive, possibly because we expect women to split a surplus more evenly between the two parties. So that's what I mean by regardless of the negotiations tactic used, it's just the same aggressive negotiation tactic can be viewed as more offensive or aggressive if it's made by a female.
That's so interesting. Luciana has a question which maybe splits your research into a more finer level, but she wanted to know if there's any observed differences in performance between same gender and different gender couples.
Oh, that's really interesting. We haven't looked at that so far, partly because of a silly data limitation, which is when we observe 2 women or 2 men, we're actually not sure if they're a same gender couple or possibly mother, daughter, 2 sisters, etc. But that said, it's a good idea and we will try to look into it.
Good information for your next research topic. Dovell asks that it's well known that most buying decisions are made by a woman buyer in America. This applies to whether you buy a house or a car or an item from a department store. Therefore, even where you classify men buyers versus women buyers, there could be a strong influence of a woman hiding behind the man. I guess that's difficult for that to come out in your research, but perhaps that is reflected more in the couple's outcome.
Yeah, I think one possible explanation for why couples do so poorly when they buy and yet they do so well when they sell is it could be that let's consider heterosexual couples. It could be that the woman is more involved in the buy decision, and the husband is more involved in the sale decision. Okay. There could be other factors such as liquidity differences on each side.
Great. Kelly, I think we're coming close to the end of our time, but I want to thank you so much for joining us today and sharing your time and your insight from your research. With that, I would like to hand this session back to Sonia.
Thank you so much, Wendy. And thank you again for this amazing presentation, Professor Xu. And thank you, Wendy, for helping moderate this session. It was a great pleasure having you both with us today. We would also like to thank our audience for joining us for today's session. We hope you enjoyed it. Stay safe. And we hope to see you on our future webinars. Thank you so much, everyone.